Hey everyone, historically FMCG sector has been a massive wealth creator for the investors. For instance, HUL jumped around 10 times between 2010 to 20 period. Nestle jumped nearly 6 times in the same timeline. Dabur has jumped around 6 times, Marico jumped 7 times and Britannia jumped exponentially in the same time period. At one point in time, these FMCG companies were known as BARP stocks, that is buy at any price, irrespective of valuation. However, in the last 5 years, these FMCG companies have badly struggled to create wealth for the investors. For instance, HUL has not generated any returns in the last 5 years. Nestle has generated around 4% CAGR return in last 5 years. Dabur has generated no return in last 5 years. Britannia has generated around 9% CAGR return in same time frame, and Marico has still done better with 12.5% CAGR in last 5 years. This underperformance has come especially when Indian stock market has seen one of the very strong bull rally post-COVID. The big question is, what went wrong with these blue chip FMCG companies? More importantly, what can be the expectation in the near future? So in this video, we'll discuss why FMCG sector created massive wealth in the past. Then second, what is the reason behind underperformance in last 5 years? Third topic would be expectation in the near term. Here I would like to discuss a very interesting topic on whether quick commerce is an opportunity or threat to the Indian FMCG sector. Based on that, we'll conclude, is this correction in FMCG sector an opportunity or trap? Alright, let's get started. So one of the biggest reasons why companies like HUL, Nestle, Dabur, Marico, Britannia were able to create wealth was they tapped the unorganized market of India in the 90s and early 2000s, where people were consuming unbranded products across categories, and they created massive brands in their respective niche. For example, Nestle captured the packaged food category of noodles with Maggi, baby food product category with Cerelac, chocolate category with brand KitKat, coffee segment with Nescafe. Then HUL created multiple in-house brands as well as acquired many brands to build a massive portfolio that include brands like Lux, Lakme, Pears, Lifebuoy, Dove, Brooke Bond, Close Up, Pepsodent, Surf Excel, Kisan, Vaseline, Horlicks and so on. Then Dabur tapped the unorganized Ayurvedic segment of India and created brands like Chyawanprash, Dabur Honey, Dabur Red Toothpaste, Almond Hair Oil, then Pudin Hara, Hajmola and so on. Then Britannia tapped the unorganized bakery and dairy segment of India with brands like Good Day, Marigold, NutriChoice, Britannia Cheese, Cakes, Rusk, Bread and so on. And Marico created brands like Parachute Oil, Saffola, Hair and Care and so on. Over the years, these brands became household name in India. Here please note that these FMCG companies do not manufacture all of their products. Many people are probably not aware that FMCG companies follow asset-light strategy, where they outsource majority of manufacturing to third-party vendors, where they focus on building brands via marketing campaign and building a solid distribution network so that their products are available in every part of the country. Since manufacturing is outsourced, FMCG companies do not need to invest heavily in factories. Since FMCG companies have created massive brands with extensive distribution network, they also enjoy high pricing power with excellent gross margins. And fixed costs were very low as less capital was tied up within factories, and their products were fast moving with very high inventory turnover. On top of this, FMCG companies enjoy a negative working capital cycle where they sell the products on cash or short-term credit but pay their supplier later. As a result, FMCG companies became cash generating machine with extraordinary ROE and ROCE. For example, HUL reported net profit of around 10,000 crore in 2024, but look at its cash from operating activity. It's 15,000 crore. And this high cash generation is in every year. HUL also used to enjoy ROCE of more than 100%. However, in 2021, ROCE fell down due to HUL acquisition of GlaxoSmithKline Consumer Healthcare Division for 31,700 crore. That brought brands like Horlicks and Boost into HUL portfolio. This led to higher capital deployed without an immediate proportional increase in profit, and hence ROCE fell down. Then Nestle also enjoyed very high cash conversion with around 4,000 crore profit in March 24 and around 4,175 crore of cash from operating activity. Likewise, Dabur, Marico, Britannia, they all enjoy excellent cash flow and they all have very high ROE and ROCE. On top of this, all these FMCG companies have grown at a very good rate between 2000 to 2020. So due to high growth coupled with excellent ROE and ROCE, negligible debt levels and extraordinary cash conversion, every investor wanted a pie in this amazing FMCG businesses. Hence, it resulted in these FMCG companies trading at high PE multiple and also creating massive wealth for the investors. Now let us understand why these FMCG companies have generated negligible return in the last 5 years. Now, one of the biggest reasons for weak performance of FMCG companies is high inflation and rising raw material cost. 2021 to 23 witnessed high inflation in commodity prices like crude oil, palm oil, packaging material, wheat, sugar and milk that resulted in increased raw material cost. All the FMCG companies command pricing power, so they pass on the price hike by usually increasing their product prices. However, the raw material price hike was steep and hence FMCG companies could not pass on the entire cost to the end consumer. Hence their margins shrank that impacted their profits. Although the fall in margin is not very high, HUL margins fell down from 25% to 23%, but it again recovered to 24%. Nestle margin fell down from highs of 24% to 22%, but now again recovered to 24%. Dabur margin fell down from highs of 21% to 19%. Marico margin also fell down, but again recovered. Then second major reason was sharp decline in rural consumption demand. Please note that FMCG firms rely heavily on rural India that contribute nearly 40 to 50% of their sales. Post-COVID, economic stress and high food inflation weakened rural income growth. As a result, consumers switched to cheaper and unbranded products that directly impacted the premium FMCG product sales. Please note that FMCG companies rely on premiumization trend that include launch of premium products to improve their margin, but that got impacted the most. Overall, rural volume growth dropped to low single digit of around 1 to 3%, which was much lower than the historical 6 to 8% growth rate. And overall FMCG volume growth dropped to around 2-3% versus 6 to 8% historical level. So fall in demand impacted the revenue growth and fall in margin impacted the profit growth. For instance, HUL has reported nearly 0% growth in both trailing 12-month revenue and profit. Nestle has reported fall in revenue and profit growth in trailing 12 months. Dabur revenue and profit are stagnant since 2023. Marico revenue growth is on lower side since 2023, but net profit growth is decent due to margin expansion. Britannia revenue has hardly grown since 2023 and net profits have fallen. In addition to all these factors, FMCG sector has witnessed increasing competition from new players like Patanjali, Mamaearth, Wow Skin and hundreds of D2C brands that have built their niche in various FMCG segments thanks to e-commerce and quick commerce industry. Obviously, when there is more competition, there is price war and also more marketing spend to gain market share. And that again impacts the profitability. Just hold on to quick commerce for now. I'll discuss it shortly in detail. So when FMCG companies were facing challenges that impacted their revenue and profit growth, one issue was valuation. Please note that FMCG companies always commanded a premium valuation because of their excellent business model. For instance, HUL PE touched highs of around 70 plus against 10-year median of around 60. Nestle PE always traded above median between 2020 to 24. Dabur also traded at high PE between 2020 to 21 period. However, when growth fell down, investors started losing interest in FMCG sector due to high valuation. Hence, FMCG sector witnessed low inflow of money and eventually the share price corrected. Please note that 2020 to 24 was also the period of sectoral rotation, where sectors like railway, capital goods, defense, PSUs, electronics, engineering sector witnessed sharp earning growth and valuations were also attractive. So money started flowing into these sectors instead of defensive FMCG sector. Hope it makes sense. Now let us understand the expectation from FMCG sector in the near term. While the inflation has been a key challenge for FMCG companies, they were able to protect their margin to an extent because of their ability to pass on the rising cost to end consumer in a calibrated manner. And that's what they intend to do further by increasing the prices to offset the raw material price rise. Also, premiumization would play a key role in margin improvement for FMCG companies. As far as demand is concerned, this is a bigger challenge. There's slowdown in both rural and urban consumption demand, and multiple factors impact this demand that include your food inflation data, then employment data, and so on. The positive news is that now Indian government has a lot of focus on improving the consumption demand within the country. They have taken various measures like income tax reduction, infusion of liquidity within financial sector to improve credit growth. So hopefully this will improve the demand scenario in India. But that is something we'll have to track during quarterly results. That will only give proper idea on ground level reality. Personally, I track the quarterly results of more than 200 companies, which is part of my exclusive weekly video series. It also includes my own investment strategies, but only for long-term investors. In case you are interested, you can explore my website or join button of this channel where link I provided in the pinned comment. As far as valuations are concerned, it has cooled off. Nifty FMCG index 10-year median P is around 41-42 and current valuations are near median valuation. So it is neither too cheap nor too expensive. But at the moment, except for ITC, which is still a cigarette dominated business, all FMCG companies are trading at more than 50 PE multiple. So the big question here is it worth paying a 50-60 PE multiple to FMCG companies when the earning growth is hardly 10%? Definitely no. For FMCG sector to command a higher PE multiple, earning growth has to improve. So if earning growth would improve, market would cheer it. But if the growth remains sloppy, FMCG sector may continue to see sideways movements. Because valuation wise, it's still not that cheap. Of course, we also need to look at the performance at individual company level. Now, since we are discussing FMCG sector, we can't ignore the role of quick commerce industry because it has disrupted the traditional distribution model of FMCG companies. And there are a lot of concern around how it will impact FMCG sector. So let's discuss it. So FMCG companies follow multi-channel distribution model that include general trade or kirana store where FMCG companies supply product to carry and forward agents. They further supply to distributor and then distributor supply to wholesaler or retailer. And finally retailers supply to end consumer. Second channel is modern trade where FMCG companies supply product to retail chains like your D-Mart, Reliance and so on. Earlier, general trade used to contribute around 80 to 85% in the sales. Modern trade contribution was around 8 to 12% and a small 2 to 5% revenue come from e-commerce platform like Amazon, Flipkart. However, the rise of quick commerce platform like Blinkit, Instamart, Zepto have changed the distribution dynamics. Today, general trade contribution has fallen to around 70-75%. Modern trade contribution is around 10 to 15%. E-commerce is 5 to 10% and quick commerce is already commanding 8 to 12% market share. Within quick commerce model, FMCG companies are directly supplying their products to companies' warehouses, bypassing the distributors. Although quick commerce is still 8 to 12% of overall business, but it's worth tracking closely due to exponential growth of quick commerce platform. Now there are both pros and cons of quick commerce model. What are the positives? Well, first bigger benefit is higher margin and premiumization trend. Quick commerce platform tend to promote premium and impulse buy products that allow FMCG companies to sell higher margin SKUs compared to traditional trade. Then second benefit is reduced distribution cost. Unlike traditional distributors or modern trade, FMCG companies can bypass some middlemen that can improve their profitability. Although one of the negative aspects is higher dependency on few platforms. Please understand this. In general trade, there are thousands of distributors and pricing power is always in hand of FMCG companies. They also enjoy very low working capital and hence high profitability. However, with quick commerce, there are only a few large players and FMCG companies have some level of dependency on them. So now the bargain power is not that strong with FMCG companies. There is also a risk of quick commerce companies demanding higher trade margin. If that happens, it would squeeze FMCG companies' margin. Also, quick commerce companies can demand higher credit cycle from FMCG companies and that can result in higher working capital days and increased inventory level for FMCG companies. So low working capital, that was one of the key strengths of FMCG sector due to high bargain power that resulted in massive profitability could be at risk. Currently, quick commerce is a double-edged sword for FMCG sector where on one side there are benefits and on other side there are risks that can impact FMCG sector profitability. Going forward, the key for FMCG giants like HUL, Nestle, Dabur, Marico, Britannia will be to balance traditional and quick commerce distribution while maintaining control over pricing and margins. So in this video, we discussed the blue chip FMCG companies of India that have struggled to create wealth for the investors in last 4-5 years. Overall, FMCG companies have a very superior business model with exceptional profitability and cash generation ability. However, the slowdown in demand and inflation has resulted in weak performance in last few years. Going forward, inflation would certainly reduce, but demand growth is something that we need to track closely. Valuations have certainly cooled off and majority of FMCG companies are trading below their median valuation. So now everything would boil down to growth, and that's where it would be important to track the quarterly performance. Also, quick commerce has created both opportunity and threat for FMCG sector, and that's where it would be interesting to see if it will have any impact on FMCG companies' profitability profile or not. Based on that, market will decide if FMCG companies should command a premium valuation or not. So personally, I am neutral with FMCG companies at this point, neither too bullish nor too bearish. We'll continue to track the upcoming quarterly results and then decide the next steps. Now tell me in the comments, what is your take on FMCG sector? Is it worth investing money at the moment, or the valuations are still expensive for the growth? And which FMCG companies you find most interesting? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.